I'm extremely happy today because I have a dear friend, Emmanuel Daniel, who is a brilliant thinker, great sense of humor, fantastic dancer, so he tells me. Um, and he is the president and founder of the Asian Banker and also Wealth and Society. In addition, he has written the book, The Great Transition. I think it's about sex changes or finance, one of the two. Emmanuel, if you unmute your mic, please tell us who you are and what you do. And also, you're going to share a presentation with us as why financial inclusion is a lie. Welcome.
Thank you, Robert, for that. Good evening to all of you. It's 9-something in the evening here in Beijing. And Robert is a very good friend of mine. I know that I have, I had used the title Financial Inclusion is a Lie in introducing this topic as a bait. They call it a catch bait or something like that. That will sort of interest as many people as possible. But the real discussion is one of financial inclusion versus digital inclusion, and why is it that we must be able to make that distinction very clearly. Just by way of introduction, my name is Emmanuel Daniel. I am the founder of the Asian Banker. For over 28 years, I've had the privilege of following very inspiring leaders in banking and finance all across Asia and eventually into the Middle East, Africa, and of course, some of the leading personalities in the US and Europe. And in that time, I came to understand a lot about the essence of banking. I'm also the author of this new book, and it's my first book, The Great Transition, The Personalization of Finance is Here. Actually, in writing this book, it's been a journey for me to understand innovation as we've actually seen it in traditional finance, and then starting to incorporate all the new things that are taking place. So I am making the assertion that finance is in a transition towards its personalization phase. In fact, in order to help us understand these big words, I put a picture of a ice cube on the cover. And that's because I start this book by recounting the story of ice in the days before refrigeration, when ice was sawn out of the lakes in Boston and Michigan and everywhere else, and taken by horse-drawn carriages across thousands of miles to New York, as far away as Havana. And just imagine what ice used to be, as it was transported over great distances, the amount of wastage and so on. And what is ice today? It's something that we reproduce in refrigerators. And what is refrigeration? It's CFC, that's how it started, which is the use of synthetic chemical to absorb heat. And today, ice is a highly personalized ingredient that we produce when we want it, where we want it, and how we want it. Now, and using that, I then go into what is the CFC of finance, right? So just imagine the money that you have in your pocket is something that travels great distances to get to where you are, and then it's subject to inflation, exchange rates, trade, politics, and bank charges, and security issues, and so on. So just imagine how inefficient finance is today. And what if we have greater control over how money is produced and value is recognized and exchanged, right? So, and I think we're in the early days of that, and I don't want to, go into supporting any trend in particular, but the technologies that exist today already tell us that personalization of finance is underway. But at the same time, what I do in the book is to try and capture a lot of the essence of finance, because a lot of what people in innovation, in fintech, and so on talk about does not take us back to the DNA of the finance industry. So you will see a lot of the first premises of banking being coagulated in the book. For example, I say that the most profitable banks in the world are the deposit-taking banks, or the ones that were good at deposit-taking, not the lending banks. That means the banks that were fully extended on the lending book. And lending in banking sits on the asset side of the business. It's supposed to be the performing asset. And deposits sit on the liability side. But go around anywhere in the world, the banks that have a stronger deposit base are the most profitable banking institutions anywhere in the world, traditionally. So then I superimpose what technology is trying to do. And then when you look at some of the digital banks that are able to industrialize the technology of collecting deposits, that's not what makes for a profitable digital bank today. And then we see that the traditional banks that have a stronger, more stable relationship with its core depositors are the ones that continue to be profitable even to this day. So there's something there. That's the magic of the industry that we need to capture. Okay, now in that same vein, when I look at financial inclusion, I start by saying that there is a lie that has been embedded into financial inclusion, especially when the theme of financial inclusion is hijacked by the platform players. So what do the platform players do? They go around looking for propositions where they can onboard thousands, if not millions, of users onto their platforms and then monetize them. Okay. Now, if that's what they're actually doing, then that they are not creating a conducive environment for financial inclusion, because whether you're rich or poor, the whole idea of the platform players is to monetize you and to benefit from you and to profit from you, right? Now, with these ideas at the back of our mind, let's look at how sensitive finance is to society and to community and to the ability of the grassroots to create sustainable financial ecosystems. The story of Bangladesh. Many years ago, I have had the opportunity to travel to Bangladesh, meet with Grameen Bank, its founder, Muhammad Yunus, and meet a lot of the women who drive the success of Grameen Bank. And this is many years ago, right? And over time, the business model of Grameen Bank, very specific, lending to small groups of women for very specific entrepreneurial goals, such as buying a bicycle to bring vegetables, fresh vegetables from the next village, very, very specific goals, made the business model successful. And on the balance sheet of a Grameen Bank or a BRAC Bank, there are 700 odd, banks like of this nature in Bangladesh, the microfinance institutions, and all of these have both sides of the balance sheet of the business embedded in the local community. So the profits that they generate then goes back into the liability side, and that funds the lending. Now, because of this discipline, in the same way that I mentioned to you that deposits, banks with a strong deposit relationship are more profitable than banks with a stronger lending relationship, and this has been over time. It is the banks that have both sides of the balance sheet embedded in the local community that have been very successful. And how successful? Bangladesh was once called by, I think it was Henry Kissinger or someone in the Reagan administration, who said that it was a basket case, a country that could never rise out of its poverty. In 2015, it entered the realm of the middle income countries. And then in this year, Bangladesh pipped India for per capita GDP. And 70% of the economy is textile focused, and all of the value chain in the textile industry has eventually started coming back into Bangladesh. There was a time when Bangladesh was a net exporter of cotton, and then the cloth gets cut in Indonesia, in Hong Kong, and China, and so on. All of that has now come back into the country, and there are designers in Bangladesh who do downstream activities and so on. And that's how amazingly this country has evolved on the back of very responsible lending that is embedded in society. And you have to look at the relationship of NGOs. Bangladesh has got a very successful NGO community. The government, the grassroots itself, and the financial institutions. Now, you not appreciate all this unless you saw what happened to microfinance when it was then exported to neighboring India. Okay, now in India, microfinance took off in a big way in the 2000s. But the Indian model was slightly different in that it was funded not by NGOs and donations and so on. It was funded by venture capitalists. Now, for microfinance anywhere in the world, no microfinance, despite any amount of technology, has been able to reduce the cost of credit to the poor. It ranges between 28 and 35%. Okay, to this day. I've seen models in China and everywhere else. It ranges in that range, and some of us might be even upset that the poor actually pay an incredible cost for credit. But the issue is not so much the cost of the credit, it's the application of the credit. So in India, multiple venture capital driven microfinance institutions lend to the same people. A lot of them are men. Even if they say that it's women, it's actually to be lent to the men of the households, who are mostly transient workers, not embedded in any specific community around any specific economic activity. And the spending was mostly for consumption. And what happened was that by the time we got to 2010, states like Andhra Pradesh, which was very supportive of microfinance originally, started to see hundreds of cases of suicides because the poor were not able to meet the obligations. They were borrowing from multiple microfinance players, venture capital driven microfinance players, and right down to the point that if Monday collection is from this company and Tuesday this company and so on. And in the end, Andhra Pradesh put in place very restrictive regulations. Now, this chart that you see in this presentation is very interesting. In 2009, microfinance occupied a certain percent of lending to the poor. And it's interesting that the poor actually have never not had access to lending, okay, access to credit. So don't make it look like as if just because of fintech and technology that they're getting more access today than they did before. That is not true. Okay, every community has a lending capacity or a capability. It's just where it's embedded. So if you look at that chart, the two pie charts, you'll notice that when the laws were put in place in Andhra Pradesh for curbing microfinance, guess where it went back to? It went back to the money lender, right? And the money lender continues to dominate the Indian, lending to the poor segment, precisely because they're actually more stable and more rooted in the local community. They know who you are, they know what you're borrowing for, they know when was the last time you borrowed, and they know where to find you, if they need to, and you have a very stable ecosystem where there are only so many money lenders that you could borrow from, and they're all at prohibitive rates. It's the cost of credit is a function of the cost of funding. Okay, it's not a function of being abusive towards the poor and so on. So we need to look for the essence, the DNA that drives these industries to understand what financial inclusion really is. And very often, technology is even the very last thing that involved. Okay, now when we say financial inclusion, we mean universal access to financial services, so areas like remittances, payments, credit, insurance, but we also mean skills. The ability to build skills as an asset from financial inclusion. We mean financial literacy. We mean consumer protection, and very important, okay, for the poor, especially today, where asset inflation and the capital markets is creating a divide between the poor and the rich. And in that, we'll talk a little bit about wealth creation. Okay, now let me go through some of these areas. The Philippines, anywhere in the world, especially where remittance is an important part of the economy, because a large number of certain population is working in another part of the world. The Lebanese in Brazil, the Filipinos all over the world, the Indians, the Chinese. Of course, India has the world's largest remittance industry, and then followed by China, and then any number of countries. Philippines. I was recently in El Salvador, and it's got a remittance industry of about, I think it's $40 billion a year. No, it's not 40 billion. Just hang on a second. Let me just see if I can get that number out. Oh, it's about $7 billion. 40 billion is a little high, but $7 billion a year. And when the country launched, or rather recognized Bitcoin as official currency, a lot of the remittance industry went into Bitcoin in order to be able to transfer funds from the US and other places back into El Salvador. And you see innovation like this taking place in different parts of the world. But what the Philippines showed us was this. In terms of choices, in terms of the remittance or payments industry, we are wanting for choices today. Let me just make this point so that it sort of builds on the rest of what I'm saying. Payments today is only a message between point A and point B. Okay. In other words, if you can send a WhatsApp message for free, if you can send a tweet for free, you can send a payment for free. Okay, and that's what in the end was M-Pesa all about. And there's any number of payment companies in Africa and so on. And if you go to a shopping mall in Dubai or in Singapore, you'll see thousands of Filipino maids and maids from Indonesia and so on making remittance payments, and a whole range of different technologies available to be able to make these payments, and they are getting cheaper and cheaper. So the technology is not where the issue is. When the banks in the Philippines started to enter the remittance industry, what they did was to complete the loop in terms of what the funding was used for. And eventually, over time, the banks started to lend against mortgages or home purchases, lend on remittances against home purchases in the Philippines. And that increased the savings rate and the wealth creation in the Philippines amongst the Philippine overseas workers, okay, the overseas Filipino workers around the world. And the Philippines, I think, has got about 2 million workers around the world. And 60% of remittances in the Philippines are used for mortgage payments. Okay, and that has completed the loop in terms of wealth creation for the poor in the Philippines. And so we looked for stories that complete the loop in terms of community stability, wealth creation for the underprivileged and the unbanked amongst us. It's not just the technology. Now, this photograph, I'm sure that many of you have seen this, many times somewhere. Okay, and I'm in China right now. So if I walk onto the streets, if I go into the small hutongs, I'll see scenes like this. It's an everyday thing. And to the small towns, okay? Although China today is really very much of a middle class, middle income, upper middle income country today. What's interesting about this visual is this picture is that the extremely poor know how to use WeChat Pay and are dependent on WeChat Pay or Alipay, just like you and me. Okay. In fact, the WeChat Pay on the phone, the mobile device of the poor, is exactly the same as the WeChat that I or anyone else uses. Okay, so they have access to just the same discount stores, the same social media, platforms and utilities as anyone else. Now, what this taught me, and by the way, when WeChat started WeChat Pay, they never used the phrase financial inclusion. Okay, now what this tells me is that the poor want to have the same level of digital access to the same platforms as everybody else. Okay, the poor want to have the same level of digital access to the same platforms as everybody else. So don't use phrases like financial inclusion as if it is directed to a certain part of the community. What you need to think about is financial inclusion that includes the underprivileged, or whatever you want to call it. Okay, the excluded part of the local community of the country into the same platforms as everybody else, and that's digital access. Okay, now, and because they have access to the same platforms and the same information and the same communities as I have, there are things that can happen in China that you probably not see anywhere else in the world. For example, there's something called Singles Day every year, okay? And it was originally run by Alibaba, but now several of the platforms in China runs this. It's basically a shopping day, just like Boxing Day shopping in the US. 1.7 million delivery men, okay, just for delivering goods on that day. It's an $85 billion industry for just one day's worth of holiday shopping or just marketing-based shopping. $1 billion in the first minute of the clock on Singles Day, okay, which is 11th of November, which is 11/11, and that's why they call it Singles Day. Okay, 400,000 vehicles. It involves the whole country as a result, and it's so important to involve people who don't usually have access to e-commerce to be part of this experience. There are those who actually make their entire sales for the whole year just on Singles Day alone. Okay, so if you can imagine a world where in different countries, in different communities, all people participate in a jamboree of this kind, then you've created community, you've created access to wealth, and you've created job opportunities for the people who are otherwise excluded. Now, what do you think is wrong with this with this particular statement. It's a World Bank report, 2021. 76% of adults now have bank or mobile account from 51% in 2011. Okay, now the World Bank, and in fact the U.S. Treasury, okay, for that matter, talk in terms of access to a traditional banking account today as if that's all what people in general need, whether they're rich or poor. The problem with that is it's the same as saying, Kodak saying in 1995 that what everybody needs is greater access to the 35 yellow box, iconic yellow box physical film around the world. And in fact, that's what Kodak was selling, despite the digital camera being perfected in about 1995. They were selling that right down to 2010, almost 2010 is when Kodak went bankrupt. But as late as 2005, just before iPhone was created about 2007, perfected the idea of having a camera on your phone. Kodak was still pushing physical film, okay, to its own detriment. And in that regard, it's what a lot of banks are doing, and a lot of governments are thinking that what people need is an expensive and I must say abusive banking deposit account. Why abusive? Think about this. What do banks actually pay for the deposits? Almost nothing. In fact, it costs you money to go out to an ATM or a bank to withdraw a deposit, right? And what do banks pay for investment accounts? A lot more. And how do banks make money from that deposit that they collect? They go out and they have their own trading accounts from which they make millions and more. Okay, so that equation of a bank deposit relationship is totally inequitable today, right? In addition to that, what has evolved today in terms of technology are digital wallets of all kinds, right? Initially, it was digital wallets on the back of platforms, but today it's digital wallets which are increasingly called mobile wallets, right? And banks are involved in that, but they are also found on platforms, community platforms, supply chain networks, and so on, right? In Southeast Asia, we have Grab and Gojek, and in China, we have Alipay and WeChat Pay, where you can deposit where you can hold your money and use it for a variety of different options, including investments and so on. So the digital wallet is perhaps far more important than a bank deposit, right? So Juniper research says that about $7.5 trillion worth of digital wallets today, going up to 12 trillion. That's about the GDP of China in 2026 worldwide, right? And mobile wallets, there are about 2.8 billion mobile wallets today, and that's going to go up to double by 2025. So we need to be thinking about platforms and technologies that helps everybody, not just the poor, to relate with each other on digital rather than on the idea of a state banking account. Okay. Now, a point that I make in my book is that the industrialization of finance is not the same as the digitization of finance. Okay, and sometimes we get the two mixed up. A lot of fintech innovations today about the industrialization of finance, doing more of the same faster than before. Okay, it's a kind of a madness, which is you're doing the same thing. You are still in the age of traditional banking, but you've industrialized it by making it easier to build large numbers of customers and so on. And when you do that, because you commoditize finance, it becomes easy for the next player to upend you, because it's just a matter of giving a bigger incentive, a better discount, a better rate, and so on. It's not even the technology. It's basically a commoditized war. Digitization of finance is different. It's the ability to find value in what you do. Now, let me talk a little bit about wealth creation in finance. So this picture is that of someone called Vignesh Sundaresan. He's a South Indian, and he was so poor at one point that he didn't have the money to buy a laptop. Okay, but for well over 10 years or so, he believed in Bitcoin. And I'm not presenting this case as in support of the idea of Bitcoin or anything like that. I'm saying that here's somebody who used to be very poor, but who believed in a certain technology and wanted to be invested in it. He could have been believing in art or in or any form of asset classes, alternative asset, as the wealthy would call it, right? But because he was totally invested in Bitcoin, he was able to amass incredible amounts of wealth. Today, he's believed to have more than $1 billion in Bitcoin. And he came into the news because he bought this art piece, this NFT piece from an artist called Beeple for $69 million. So far, the highest paid for an NFT piece. And he displays it in his metaverse exhibition hall, where you need to have a virtual account to go in, and you can actually enjoy it as if you are in a real exhibition hall, except that this is virtual. What was interesting, there are two things that are interesting from this person's experience, which is that governments put a lot of restriction on the poor having access to new technologies, to new digital opportunities, okay? But no access on the wealthy. In fact, when you think about it, right, a report that I just read, the Center for Retirement Research said that from December of 2021 to today, the total losses on 401k accounts in the US because of the market downturn was $1 trillion. And the total losses on IRA accounts was $2 trillion. So that's like $3 trillion of total meltdown in middle-class income in the US. And governments say nothing about protecting the middle income. Okay, and here governments put so much restrictions on the poor. And when you think about the opportunities that are being created in new technologies, the other interesting thing about Vignesh or his pet, or his name, the name that he gave himself is Meta Cohen, is that a girl wrote into his blog site saying, a Singaporean girl, and now he lives in Singapore, by the way. So she wrote in and said, you've got $1 billion, you better diversify and buy property instead, and take money out of your account. And to which his response was that, no, he's going to be 100% invested in Bitcoin for as long as he believes in it, right? So he's still 100% invested in Bitcoin. And that's the kind of passion that actually contributes to the evolution of technology, to the evolution of the future, when you have people believing and having that amount of focus in what they believe to be the future. And poor people have as much right to be invested in technology and in this way. And I think that it's wrong for governments and regulators to exclude the poor from such access. interesting thing is that central bank digital currencies, M-Pesa, and so on. Well, the whole discussion on the possibility of central bank digital currencies, I want to deal with that separately. I have an opinion on that. Okay, but one lesson that we learned from M-Pesa is that it was very, very successful in Kenya, where the level of access to banking was very, very low. Okay, but when M-Pesa was extended to or exported to other parts of Africa, Nigeria, where there's a much stronger banking accessibility, and definitely South Africa, which is very high, it was not very successful. Okay, so this mix between bank accessibility and new technology has to be leveled out to be able to decipher the level of acceptability and the ability to create financial inclusion in different markets and of different texture. Okay, so markets which have a lot more banking access will push back on simple technologies that are already available, such as remittance and payments on a mobile device. In fact, the most developed market in terms of credit cards, the US, pushes back because the number of players and the accessibility to credit cards makes it really difficult for the US to reduce costs on new technologies that makes it possible to do that. Okay, and of course, India's Aadhaar, which gives a digital identity to everyone in the country, made it possible for India to succeed in its UPI infrastructure, which is a universal payment infrastructure that is now the world's largest as a result. Okay, so for those of you who want to have a look at my book, it's on my blog page, which is emmanueldaniel.com. I talk about the essence of finance and then project that into the rest of the innovations taking place today. Okay, thank you very much.
Thank you, Emmanuel, so much. If you can close the shared screen, I want to jump in to take some of the questions because we've got quite a few questions here, and I have some here, but I want to give preference to the audience. So Aaron Wembley wanted to know, do the provisions for loan losses that banks carry on their balance sheet become overly leveraged / costly when working with consumers of a certain risk profile that is endemic to least developed countries?
So the average APR loan rate for microfinance, for lending to the underbanked high-risk customers around the world, regardless of technology, is between 28% and 35%. Okay, and that hasn't changed. All the technology in the world hasn't changed that. Now, in China, in the last 10 years, and they stopped doing that since from 2018 when the regulators came into the peer-to-peer lending business, for example. They were developing very interesting ideas of risk profiling. For example, suppliers, 800,000 suppliers to a milk factory, were given credit because of the relationship with the milk factory, that kind of thing. And I think there's a lot of innovation that should take place in risk profiling and risk management that will help us to change how we measure the risk that is inherent in lending to the poor. Banks actually lose more money to their top 2 or 3 corporate customers than they do to all the poor people in their economy. Okay,
really?
And this is a stated fact. In fact, even in Bangladesh, banks go under because of one corporate customer instead of 800,000 or a million poor people. Okay, so it's not the subprime customer that creates bank crises anywhere in the world. It's actually a few corporate clients in that way. Now, and banks that hold non-performing loans in their portfolios, a lot of that they hive it off and they chunk it off to asset management companies and so on. They are not subprime loans at all. Okay, subprime loans are actually unmanageable and non-tradable in a lot of ways. Now, what's interesting also is that, like for example, when Citibank tried to build its credit card business in Asia, in countries like Indonesia and Vietnam, they didn't have any credit profile, right? So the original credit losses were about 25% of their loan book. But what they did was they factored that into the cost of the business and to learn what the credit profile of that country should be. And this was in the 1980s, into the 1990s, and that's why by the 1990s, Citibank became the largest credit card player in Asia with a lot of confidence that they could continue to grow their loan book because they actually understood their customers. So credit cards, 25% loan loss provision is normal. Corporate customers, much higher than that. And subprime, it is a story that's not being told, not being developed yet, because regulators are putting a lot of restrictions for subprime and for the underprivileged, the unbanked.
Alex wanted to know, what do you mean by a mobile account?
Mm. Actually, a lot of the research on mobile accounts are now in transition as well, right? So in the old days, mobile meant your traditional bank account, and it just happens that you can have a look at it on your mobile phone. But there was a new mobile development that was coming from the platform players, where because you use their platform for taxis, for social media, and so on, you could actually have an account, a wallet on their platform. And that industry grew incredibly. Not only grew in countries, but cross border as well. So if you take something like, when we take something like Alipay or WeChat, we're talking essentially about one country. But when you take something like Grab in Southeast Asia, and Africa is now developing platforms like this. 14 countries, 140 million people across 14 countries and as many currencies around the region, a done deal. They can use the mobile wallet to pay each other if they wanted to. But what happened was that the regulators of each one of these countries came in and said, firstly, we don't allow you to go cross border. Secondly, we put a lot of restrictions in terms of customer data and so on. And then they started recreating cross-border accessibility through, after they had sorted out their legislations and their domestic laws and stuff like that, banking laws. And when they did that, they added incredible amount of costs. Now, what's happening now is that a number of the digital wallets that developed on the platform front are being are being tied back into bank accounts. So then the question is, how much of it is bank accounts and how much of it is authentically a digital wallet that exists on a platform? That's a little bit getting into gray areas now. You can assume that a country that's well banked, like anything above 30% of the population is banked. The regulators are coming in to say digital wallets should now be tied to a bank account on both sides of the transaction. But in countries like in the Philippines, for example, the biggest digital wallet was a non-bank digital wallet that was used a lot for cockerel fights in the villages. And it became the largest digital wallet in the country. And today it's got a banking license because the banking regulator insists that it is regulated like any other bank. But its real business is digital wallets.
Janelle had a question. There are countries like Jordan that create national financial inclusion strategies that are rolled out by the government to survey the landscape and better support financial institutions. So, do you think that as a starting point, remedies some of these issues to ensure the outcomes are better targeted for low income communities?
Outcomes are better targeted for low income communities. Um, you know, the the holy grail of the low income communities in today's world is to just give them digital access. That's all they're asking for. That's all they need. Um, if the and look at the outcomes that regulators are working towards right now. They are working at outcomes that works in their favor, not in the favor of the unbanked. They are looking for outcomes that preserves the banking system, outcomes that enables them to do their KYC, know your customer, and so on. Preserves the outcome to bifurcate uh, the rich and the poor. They allow their rich to do so many things which generates wealth today. All the work that you can do as a poor person over a 30-year period does not compare to a stock price that went up just yesterday. So why are you not giving your poor equal access? Now, interestingly, when India went into the Aadhaar UPI payments platform that gives universal access, right? They didn't, they didn't bifurcate it as for the poor or the unbanked and so on. It's for everybody, and precisely because it's for everybody, the product that went up the most in utilization was IPOs, initial public offerings. And more middle income and poor people are participating in capital raising exercises in India as a result of the UPI. So the intended consequences sometimes you have unintentional consequences depending on where the poor perceived wealth to be generated, and I think that regulators shouldn't put themselves in a position to make a judgment call on that, because we are now entering a digital age.
Alex wanted to know, could you give him a clear definition of financial inclusion and digital inclusion?
Okay, I started by saying that financial inclusion is a lie, because whatever financial inclusion's original definition is, today it has been distorted by the platform players. So financial inclusion, according to the platform players is simply uh, putting as many people on platforms and monetizing them. That's financial inclusion. No matter how they describe it, to make it sound more equitable or more advantageous for the poor, that's actually what is happening in financial inclusion today. When it involves venture capitalists, platforms, and technology-driven financial inclusion. Okay, uh, digital inclusion is simply poor people saying, "Give us the same access to the digital economy as everybody else has, and leave it to us to work out how we want to play this." Okay, now it may sound like a tentative sort of a definition, but the other definitions that you have on both these terms uh, are missing the point. Okay, and they're elusive. They don't deal with the substance of what's actually happening.
Aaron wanted to know, is there potential for a global unified digital currency underwritten by someone like the UN or World Bank?
Underwritten. See, the thing about the whole idea of a global reserve currency is who volunteers to take responsibility for it. The reason the dollar is the world's reserve currency is because the US has washed its hands of the dollar that's circulating outside the US. 70% of the dollar circulates outside the U.S. The U.S. has laws about that money finding its way back into the U.S. It doesn't care what happens to the dollar outside of the U.S. All other countries care about what happens to their respective currencies. And the idea of a global organ or a body, regulating something that is a global unified currency, we've done that before with gold twice. And where it fell apart was that the individual current countries couldn't, or rather the US most of all, couldn't hold the tag as long as they were the world's largest trading nation on the liability side, that they were actually losing more money than gaining as a result of being a trading nation. So the idea of having a unified global currency managed by a entity that is agreeable to all parties, it's been tried before with gold, and if it is tried again now, um, you know, firstly, you're going to find lots of different blocks, taking shape because they don't want to be subject to each other. And secondly, um, um, the the um, I don't want to say the obvious, but really the thing is that most countries work to their own interest. And right now we live in a world where most countries, many of the important economies around the world are in deficit. They have fiat currencies that are in deficit. So they would not want to have their currencies exposed to a global regime. And I say this also about the countries that are trying to promote their currencies as a global reserve currency. They want the benefit of it, but they are not willing to take the responsibility that comes with it.
Okay. Last question. Beata wanted to know if you were going to describe or sell crypto and digital currency solution to a complete crypto skeptic, I guess you meant, what would be your main points to convert them?
Well, it depends on what their main concerns are, or their main reservations are. And the reservations come from several different fronts. Um, the and actually the book deals with this quite in a structured way, which is that we are now moving from an institutional and a markets driven world to a networked world. So everything that anyone who exists in the markets world, if you take a Warren Buffett, or someone like him, okay, who everything that they say in the markets world is true, which is, when you buy a security, it must be, it must be a performing asset. It has to be a real business and all that. Okay, and if you exist in the markets world as it is defined today, they are saying all the right things. And then when they assess something like a crypto, they're looking at it, and they're saying, well, it doesn't conform to the rules that that I've played with for the last 50 years. But then when you start taking into account the elements that are taking us into the next phase, which is the networked world, a new set of rules are evolving right now, are coming into being. And the people who already are natural to those new rules are native to it. And they see things that the people in the markets world or the institutional world don't see. So it's a question of where the person that you're talking to, is playing right now. Now, there are people who totally believe in crypto, like I gave you the example of this young guy, and there are people who like him, are fully invested. In fact, they are so passionate about crypto that they give up a lot of things about everything else that they own as assets, and they're creating the new networked world. And what happens in the networked world? They are in contact and communication with others who are like them. And what's happening there? Thousands of young people are creating applications around these cryptocurrencies, these digital assets that are being created. And that's something that's not happening in the markets world. The markets world is a buyer-seller world, which is, you've got an asset, you sell it to me, and the deal is done. And I profit, and you buy the asset, and you hope to profit in another trade. In the network world, the more that the asset that you own has applications created around it, the more the opportunities that comes from that asset and the valuation of that asset goes up. I know that right now there is a lot of distraction in things like fraudulent transactions, crazy guys setting up decentralized finance platforms and so on. But that world will work itself through. And so if you're native to that world, you will understand all the assets that exist in that world. Okay. And if you're in crypto or blockchain and you went to a conference and saw how many thousand people are building applications around the different cryptos, you will understand why there's such a belief in that ecosystem. So you need to know where you're taking that person you're speaking to, where his beliefs are today, and where you're taking him to.
Okay, we're come to the end. I'd like to thank you, Emmanuel. Thank you so much, and I will be sending everyone who registered and who attended live the link to the replay that you can watch it again, and also some information about Emmanuel's book and some of the things that he does. I'd like to take a group selfie, if that's okay with everybody, to actually prove you were working today. And just say hi to the camera, and it'll collate that. I want to thank Emmanuel Daniel for a brilliant talk. I'm going to go into a mixer right after this. For those of you who want to join, you're all welcome. Again, I want to thank Sam, our producer, crypto genius, and ramen critic, Ricky, my absolute better half with no filter, Xi Jinping, our head of transparency and integrity, Vladimir Putin, advisor in military strategy and human relations, Elon Musk, our humility coach, Donald Trump, our Zen master, and Gerhard Schroeder, global head of neutrality training. So thank you all very much. If you want to join us for this mixer that I'm going to start shortly, just stay here, and then you'll be connected with one person for a 5-minute chat, and you'll meet the maestro himself, and you could have a big argument about blockchain, crypto, and why the banks have to charge so much money to transfer money when it's just an email. All right. Thank you all.